the Property Pod. Welcome to the Property Pod with Moneyweb. The property sector is an ever-changing sector. And in this podcast series, your host, Suren Naidu, chats to movers and shakers in the property industry.
Hello and welcome to the latest episode of the Property Pod, South Africa's leading property investor podcast right here on Moneyweb. We are taking a slightly different take on today's podcast with an economist as our guest. On this week's show, we have Gina Schoeman as our guest. She is from international banking group Citi and is regarded as one of the country's most savvy economists. Since this podcast is on property, we are taking a refreshed look on interest rate expectations. Obviously, it's a very uncertain and volatile market with the Middle East situation and the Iran war. As we know, it's affecting our markets in South Africa. We're pretty exposed to what's happening globally. But we're also going to ask her about a broader economic outlook for South Africa, especially since Citi had an economic briefing earlier this month, looking at different sides, not just from a South African economy perspective, but also a broader African perspective. We're going to keep it local, though. Gina, welcome to the Property Pod.
Thank you for having me.
Gina, it's a question I'm sure all economists get asked every so often, but we have an interest rate decision or MPC announcement coming up in May. What is your, or rather Citi's, expectations on the interest rates or repo rates front in South Africa? Hike in May or further hikes later this year, or a hold?
Unfortunately, we've had to change our view. Before the Middle East crisis, it was quite clear that with everything going well, especially with South Africa doing a lot more work on its domestic front in terms of reform, fiscal discipline, monetary policy targeting, we actually expected 3 cuts this year. But now that the Middle East conflict has created this ongoing surge in oil prices, which means not only the hikes in fuel, transportation, but other supply side issues such as fertilizer that is likely to feed through to food inflation. And then at the same time, we also have this warning of El Nino coming down the line. So if you put that all together, we've now had to, unfortunately, due to the Middle East conflict and its impact on fuel prices, food inflation, supply chains, we have had to upgrade our inflation outlook to the point where we now see 2 interest rate hikes from the South Africa Reserve Bank, 25 basis point hike in May and another 25 basis point hike in July.
So it's a double whammy for the next 2 MPC decisions. Could things change? Is it a bit of crystal ball gazing? The Middle East situation is quite a fluid situation. Things change on a daily basis.
Absolutely. So I think the big takeaway from all of this is that the forecast errors on one baseline scenario is going to be much higher at the moment, simply because no one can tell from one day to the next how long this is going to last for. So there is an asymmetry of risks around this baseline forecast. We only think the SARB would have to hike twice because they're already in restrictive monetary policy. That means they didn't cut as much as some people thought they should have. They also didn't cut as quickly as some people hoped they would, and they didn't cut as much as some other economies. So that does insulate us to a degree. So only 2 interest rate cuts for what we currently think, around about $100 per barrel, currency around 16.50, 16.75 against the dollar, and then some food inflation on top of that. 2 rate hikes should be enough to contain inflation over an 18 to 24 month period in order for it to converge back to the 3% point target, or at least within that tolerance band from 3 to 4%. However, if the war had to end today, you might find that the SARB would be able to either postpone the first hike, not hike at all, depending on where levels for oil prices and currencies go, or at least be able to maybe only hike once and see that a second hike is not necessary. In the event, however, and they did give this as a scenario in their most recent MPC statement, if this war in the Middle East continues and the oil price remains elevated, and when I say elevated, I'm talking about something, $80 per barrel for a lot longer or higher, together with a currency that's somewhere above 16.50 or around there, unfortunately, that still gives us too much inflation down the line, and then the SARB would still be less likely to cut more likely to remain hawkish and a wait-and-see approach.
People are caught up in the situation, so everybody focuses on the $100 a barrel, not realizing that, it was much lower at the start of the year. So I fully understand what you're saying around the $80 also being a fueler of inflation, as it were. Now, Gina, on the positive side, you said, because things are so, could change quite dramatically, you kind of shared a sentiment at this economy briefing, or perhaps a hope that, it could be a year of two halves like last year was. Can you share some thoughts on that, things might turn around totally and we might forget about the war before we know it and it all happens in 1 year?
Yeah, and we've seen that movie before, especially under the current geopolitical stage, I would say. Last year was a year of two halves. The first half of last year for South Africa really looked quite horrendous. Second half of the year, we became the Goldilocks across emerging markets. And that's simply because I think South Africa kept its head down on its domestic issues and carried on persisting on reforms, fiscal discipline, monetary policy targeting, and then also local GNU political stability. Now, those things have not gone away. And that's why we could still see a two halves of this year. In the event the war had to end by middle of this year, and oil prices had to move to about $70 per barrel or lower, then South Africa's domestic story is going to give the currency, the rand dollar, enough space to get a bit stronger like it had at the beginning of the year. The only reason it's really weakened now is because it's emerging market currency and because South Africa is a small open emerging market. There's EM risk off at the moment. But South Africa within this emerging market currency universe is actually still seeing a currency performing far more resiliently than it usually would under these type of global conditions. I mean, if you think about this hitting South Africa 10 years ago, even 5 years ago, I don't think anyone would have expected the rand dollar to be trading in the 16s against the dollar. We got up easily to 18, 19 during pandemics and, Liberation Day last year. So South Africa has been doing its homework domestically. And as long as we can keep those things in place, should the global stage become a lot less volatile and a lot less surprising, then we can revert back to what I would say would be quite a calm and steady hand for South Africa, which means not necessarily all the rate cuts we thought would happen, but we won't necessarily have to hike as much. Perhaps we don't hike at all. We cut at a later stage. But I think what's also wrapped up very neatly in all of this is that we've even heard from S&P that even with everything going up to this point, they're still not inclined to move away from their current rating status for South Africa and positive outlook, because this is a relative global story. South Africa, from an individual country perspective, has actually continued to do the right thing.
What more can we do? Continue on the reform agenda. I know, there is more comments around Operation Vulindlela being taken down to local government level where a lot of problems are. And perhaps you want to bring in a little bit of your SA GDP forecast, because that also had to be re-evaluated.
Yes, absolutely. So unfortunately, when inflation goes up in a country like South Africa, where household spending is the biggest driver of growth, when inflation goes up and erodes disposable income, it just means there's less money to go around the economy, which means that GDP will take a knock. What it also means is that when you have global uncertainty, no matter how well South Africa tries to keep its domestic issues going, your investment case on any long-term investment is going to move more to a wait-and-see approach. So big capex plans typically get put on hold. So we also lose some of that investment in impetus. And that means we've taken down our GDP growth forecast this year from 1.6% at the beginning of the year down to 1.2%. But I would still like to say that there might be a bit more downside risk attached to that. But I'm still very happy that we're at least still set to print above 1, or at least in the ones for 2026, despite this global backdrop. Now, if we think about what more the economy can do, think about the structural reforms. We have to just continue with the energy reforms. We have to continue with the progress on Transnet. But for the local municipality service delivery, there are two very key things here. Number one, we have to make sure that the lead up into that local election is calm, that we manage as a country to separate the local politics from the national politics. We want the GNU to remain stable so that the one does not feed off the other, because local politics will just become noisy. And we know that there is a huge amount of competition to take over some of these metros. And the reason there's this competition to take over these metros is that if you are a governing party of a big metro that is getting help from Operation Vulindlela over coming years in order to improve service delivery, well, that makes it really easy for you to grab more votes in the future, because you'll be seen as the party to thank. And so that's why the local service delivery is so important. The other reason I would say service delivery as a reform is so important for growth in South Africa is that I made this point to you during our city briefing. Business confidence has typically always been determined on a top-down measure in South Africa. So in other words, businesses, those making investment decisions, the corporates, look at the economic outlook and decide whether they are confident enough to make their investments on a 5, 10, 15-year basis. However, lately, even though the top-down story, so we're talking about the energy reforms, the transport reforms, even arguably the political stability we've seen more recently, that might have helped to improve business confidence from a top-down perspective. But remember, those making investment decisions that live in South Africa, that are based in these metros, are still experiencing this deterioration from a bottom-up perspective because of this municipal service delivery. And that is always going to have a negative knock-on as to how their general sense is of being confident about the economy around them. So when they're thinking of whether they are confident to make the investment, they're still thinking about the number of potholes, lack of water because of local infrastructure, lack of electricity because of local infrastructure, even if the top-down story has improved. So that's why the local service delivery reform is the absolute third piece of this puzzle that South Africa has to get right, especially if we want to attract, just the ease of doing business and therefore the investment case for South Africa. But I would also add on top of that, fiscal policy is something to watch. We've seen government step in and National Treasury give citizens and the country relief from the fuel levy burden in April because of those fuel price hikes. And now we're seeing whether they're going to do so again, because we've got another big fuel price hike coming up in May. They don't want this to become a habit. They don't want everyone to think that every time the oil price goes up, they just suddenly step in, because it costs money. It's lost revenue, and that lost revenue would otherwise go somewhere hopefully useful. So they have to be careful about the way they manage communication around this issue, giving a bit of relief here and there, but not making it something that's unsustainable, because South Africa desperately needs to keep its fiscal story intact. And then finally, we know we don't like interest rate hikes, but I can assure you that if inflation is as problematic as we think it is, because of simply what we've seen so far, and the South Africa Reserve Bank does not step in with at least some modest rate hikes to try and contain inflation, then your currency is going to grow a lot more legs and weaken further. And this is because investors, financial market participants will have a look at South Africa and say, but how is inflation going to help things? It's going to create worse growth, especially for low-income to middle-income individuals, and potentially social or political instability, because it impacts contain the inflation. And that's where monetary policy hawkishness is actually a useful part of the reform structure.
Now, Gina, I don't want to go too much into the economy side other than what you've already mentioned. This is the property pod, and I want to bring in a little bit of what you said of businesses taking a cautious approach. Now, you also talked about fixed capital formation during your briefing. And the president had his latest SA investment conference in March, and there was a lot of hoo-ha around the 900 million rand in investment pledges. But we do know that South Africa's private sector is sitting on 1.6 to 2 billion rand in savings, as it were. You saying that they're going to be cautious and not necessarily spend. Can you give us an update from that fixed capital formation perspective? Because that what was mentioned in that investment conference is not necessarily fixed capital formation.
Yes, we have to be very careful around the definitions of this. And we also can't look at the private sector when everyone says they're sitting on all this money as if they're the bad guys who aren't willing to deploy it. They still have either private or public shareholders to answer to.
Yes.
And if they don't make the correct investment decisions that are deemed responsible, that are deemed to come with a return on that investment, then you know what will happen to that company. No one will want to buy any type of shares or any type of equity in it. And that company will not be able to profit and do as well. So they have to be very careful with their decisions. So it's not always that they're just sitting on cash that they don't want to deploy as investment. And it's not always that this investment pledging that we see our president talk about, is necessary capex that can be put down on the ground right now. A lot of this is working capital. A lot of this is operating, maintenance, replacement. We need to make sure that none of that goes away, because that will then create a deterioration in capital stock in South Africa. In other words, just a worse side of infrastructure. So we need to continue at least with replacement and maintenance, which I believe we can. It's just that in this global backdrop, you're not going to have the type of investment outlays that you would if the global backdrop were a lot more stable and a lot more investor friendly. It's just more precautionary. So this has got really very little to do with South Africa and far more to do about the global backdrop. If that improves, and suddenly companies don't have to worry about what might happen from one day to the next on things like the oil price and currencies and food prices, etc., and trade and subsidies, etc., then of course they have just more certainty to be able to make these investment decisions and more certainty on the return of them. Maybe let me leave you with something that is quite a useful way of thinking about investment in South Africa. At the moment, as a percentage of GDP, investment is sitting somewhere around 13-14%. Now, for those who remember back in the heyday of the 2000s, South Africa enjoyed an investment to GDP ratio in the below to the middle 20s, so about 24% of GDP. That's when we were really doing well as a country and investment was easy to come by. And obviously then your economic story, your domestic story, your global story, allows you for that return. So you see that investment arrive. Now, if South Africa is able to do what it needs to do in terms of the basics, so all the reforms, service delivery, energy, water, and the global backdrop had to correct itself or at least stabilize somewhat, we would expect investment as a proportion of GDP to rise from 13% of GDP to around 16% of GDP. Now, that still doesn't sound like a lot relative to the history, but the reason that's so important is because when you hit around 16% of GDP, that's when the type of capex starts spilling into wage bills. So it's not just about building something bigger and expanding operations. It's about being able to pay your employees more and hire more employees because you need more people. Now, that's the golden key to a more sustainable, stronger potential growth rate for South Africa. And that's your golden key for the unemployment story that we seem to talk about never ending in South Africa.
Nice point there about the operational capex, because I think a lot of that, for example, with Sasol, they talked about 60 billion, but I'm sure a lot of that is what they usually would spend in a year. It's not like they're building a new St. Charles in South Africa or, that US investment that they had. But there were a number of other developments that were announced, but some of them have been on the cards for a number of years. So I've covered the Club Med development on the KZN North Coast. They have also highlighted a couple of developments in Waterfall City. And the reason I bring those in is because this is the property pod. I know Citi as an international banking group takes a more macro view. But how do you unlock, is it this gross fixed capital formation and infrastructure spend? How does that stimulate the property sector and perhaps you want to end a little bit on the interest rate impact, if you can, please.
Oh, absolutely. No, the grassroots, the bottom-up story here is very, very important. So I know those pledges may have existed for quite some time, and it's not necessarily new CapEx, and a lot of it is OpEx, so operating capital. But it's still very important that that continues, because in the event that doesn't continue, so this is that replacement maintenance, so really just keep things the same, then you're going to see a deterioration in your infrastructure in South Africa. And we can't afford that, because any infrastructure that deteriorates from its current point in South Africa means that your property market is going to take a hit. It's unfortunately going to be negatively impacted. And we're not expecting that. You know, this might be a global event that has come out of nowhere that no one expected and be very severe. But it's not something that we expect is going to change South Africa's investment story on a medium to long-term view. So as soon as it's over, whenever that is, and I don't want to put a timeline on this because it's obviously so difficult to predict, it is still very important that all of these bottom-up reforms, particularly the service delivery, continue to progress. And the reason I say that, particularly with the local elections coming up at the end of the year, is because that's the story for 2027 onwards. If you can't show that, for example, Johannesburg or the province of Gauteng is starting to make progress on local service delivery, it's going to be very difficult to justify a bottom-up investment project, you know, from a CapEx perspective. And that will obviously have its knock-on effects to everything around it. You know, this is where I'll give you a completely different example on the inverse of this. If you look down in the Eastern Cape and you think about everything that happened with tariffs in the Eastern Cape, and obviously an automotive industry there that is crippling because of all of the tariff adjustments that were put into place, and also South Africa's geographical position when it comes to trading so much in automotive vehicles. That can have a very dire effect, given that the Eastern Cape as a province is so unbelievably concentrated to those supply chains. So in the event that automotive sector had to go away, every supply chain that would be feeding it, I mean, we're talking about shopping malls, we're talking about offices, services, etc. Everything in those supply chains feeding that massive, highly concentrated automotive sector would also have to go away. And that's why it's so important. So if we think about then projecting this onto a province like Gauteng, which is seeing the biggest net migration across the country, it is very, very important that these service delivery reforms, energy, transport continue to progress in the right direction, because it obviously then creates impetus for supply chains, which is always your multiplier effect that we hope happens in South Africa. So let me just end off on the interest rate story and maybe give everyone a bit of hope. When I say it's a good thing if they need to tighten interest rates very slightly in order to contain inflation, believe me, the sooner they do it, the better it is, because if they leave it too long, they might have to tighten by more. If they hike twice this year and things settle down by the end of the year, then you're going to have some very nice base effects in 2027. And already by the middle of next year, we can see rate cuts come back into the picture. And then, of course, we can move to that structurally lower interest rates that we thought would happen sooner, but now because of the Middle East crisis, seems like it's going to just come a little bit later.
Gina, that's the perfect note to leave it on, a positive note that it's just this year and hopefully we have back to cuts in 2027. Gina, thanks so much for your time on the podcast today. That was Gina Skuman, the SA economist at Citigroup.
Thanks for listening to the Moneyweb Property Pod with Suren Naidu. To listen to more episodes, go to moneyweb.co.za or the Moneyweb app and follow Moneyweb News for daily updates. Follow Suren on Twitter at Suren Naidu for more of his property industry content and other business stories. The Property Pod.